Let's talk a little bit about the effect that emotions have on our investments and our investing behavior. Now, we know that our brain draws us to things that give us pleasure and make us happy, and helps us avoid things that cause us pain. So, does that really help us? Do our emotions help us when it comes to our investments? Well, let's take a look. We know historically, the history of the stock market or bond market or interest rate market, real estate market, any market that you want to think about, is a series of ups and downs. We also know that we're told in the general media to sell when things are high and buy when things are low. So if the stock market goes up, we're supposed to sell, take profit. And when the stock market goes down, we're supposed to buy or buy low. Our emotions essentially reverse this for us. What happens when things go up, we're happy, we're excited, it gives us pleasure. So guess what? We want more. We get greedy. So when the markets go down, we panic. And we want to sell. If we repeat this process over and over, where we in fact buy when the markets are high and sell when the markets are low enough, we will get frustrated and give up. And we will settle for the easy way out and not invest in the stock and the bond markets. So how do we handle that? How do we trick our brains into doing the right thing at the right time? Well, here's what we do. One simple technique, and it's simple, is called rebalancing. There's a lot more to it than just this, but just let me show you the simple way to illustrate it. If this is the stock market and this is the bond market, or your portfolio is broken up into two different components, investments that are geared towards growing for the long term, and investments that you may be needing in the short term for income, this is the bucket that we hope to set aside and let grow. This is the bucket that we may draw from earlier. So let's say you're a moderate portfolio, a moderate risk level investor, and your portfolio is made up of half and half. Half growth investments and half income investments. And all of a sudden the stock market goes up, as it did last year. Think of this as a teeter-totter. Your portfolio is a teeter-totter that keeps swinging back and forth. When the stock market goes up, all of a sudden, our portfolio is out of balance. What happens here is, let's say it goes up to 60% stock, and then that means that the portfolio is now 40% income. Your risk level is now substantially higher than you bargained for. Well, most people would say, that's doing great, let's let it ride. Well, here's what happens. If we go back to the normal ups and downs in the market, predictably, we can tell you that at some point in time in the future, this will go down, and now you're far more exposed to the stock market declines than you expect it to be, and it's going to hurt a lot more. So what do? We rebalance. Rebalancing is a simple process where we take the profit from that which has gone up and invest, bank the money essentially, invest in the portion of the portfolio that has gone down when it's the safe side of the portfolio. What did we just do? We sold high and bought low, just as we're taught to do. Well, what happens if the stock market goes down? So here's your teeter-totter, your portfolio, and the stock market now comprises 40% of your portfolio, and the bond market now comprises 60% of your portfolio. Now it's out of balance the other direction. Perfect buying opportunity. We take our profit, just as we did in the other scenario, but we take our profit out of the income investments, the safer investments, and reinvest that money into the stock market to get our portfolio back to 50-50, back to the same level of risk that we bargained for. What did we do? Once again, we sold high and bought low. Very simple process. Now, what happens in the meantime are the types of investments that are appropriate for your stock portion of your portfolio can shift. So when we rebalance a portfolio, We might be slipping one particular investment in while we're pulling one out based on timing. And the same thing is true with income investments. We may be making adjustments to your portfolio on the stock and the bond side. It may look the same, 50-50, but the underlying investments may change as well. Yet another technique that we might use to safeguard your portfolio and make sure that it's on track towards reaching your goals. So rebalancing is a simple technique. It's not very complicated on the surface. Behind what goes on can get a little bit more complicated, but it's what we don't do the majority of the time.